This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. Our lead story today, global financial chaos looms as a doom loop threatens to unleash a tidal wave of selling. And you're not going to believe where this is going to originate from, what the triggering mechanism is, and just how much damage it can do to the global equity market. Plus, central bankers are starting to get cold feet. We're going to show you why and what it's going to take for them to start cutting rates. And while many people believe inflation is going to continue higher, we're going to show you some evidence of what's driving inflation and why inflation's about to come down in a big way. And if you're wondering what we're doing at JP Morgan today, well, if there ever was a sign of a market top, this is it. Let's over to Bloomberg, where we picked today's story up with a headline. Jamie Dimon, the CEO of JP Morgan Chase, plans to sell $141 million worth of the bank's shares. And Dimon continues to believe the company's prospects are very strong and his stake in the company will remain very significant. Well, if you want to know, how do you sense a market top? It's because that tends to be when people sell. Now, when CEOs sometimes sell, it's because they have other projects or other businesses are running that need cash flow. But otherwise, when you start to see executives at the top of the market unloading shares, it's one of the best signs of a market top, because if you don't think that Jamie Dimon has access to all the data at JP Morgan and knows what it means, he sure does. The planned transaction, which is subject to the terms of the bank's stock trading plan, would be the CEO's first such stock sale during his tenure at the company. And Wells Fargo analyst Mike Mayo noted that Dimon's stock sale plan, quote, comes after his bearish comments that include the possibility of interest rates increasing to 7%. So here you have, the CEO of the largest bank in the United States, bearish notes and saying, wait a minute, if he is bearish on the banks, well, it makes perfect sense why he would sell, because we've talked about how higher interest rates actually haven't been beneficial to the banks. The main reason why is people don't want to borrow at higher rates, so it's not actually helping them out. But there's another reason why Dimon might want out. It's because he knows what's coming, particularly if he sees these doom loops starting to originate. There's a big reason he wants out, and now. And an uninvestable banking sector. Well, if something's uninvestable, that means prices are coming down due to the burden of the proposed Basel III in-game requirements. The timing of his first sale with these comments got our attention, Mayo said, adding that the plan also serves as a reminder that the CEO is getting closer to retirement. But even then, doesn't matter if he's going to retire, because if he believes in the company and the stock and the dividend is paying, it shouldn't matter to him. But we know more banking regulations are coming. And if a sector becomes uninvestable, it doesn't mean the price goes up. It means it comes down. But there's another factor that Dimon knows here about the equity markets and their connection to the banks, is that the banks, when they restrict the amount of new money entering the economy, well, it has bad news for the price of equities, and all the more reason he'd want to sell now. And here you can see the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes. And of course, JP Morgan Chase would be one of those banks. This against the Wilshire 5000 price index or the total U.S. stock market. And here you can see when the blue line is above that horizontal black line, that means on net banks are tightening. As it goes up, they're tightening faster. On the way down, they're tightening at a slower rate. And sure enough, what you can see throughout history is that as banks tighten lending standards, what happens to the equity markets? They start to go down. You see it during the dot-com bubble. We see it during the global financial crisis. And the reason is simple. In order to maintain these high equity values, you have to have enough money created so people can keep buying them. And if your banks aren't creating enough new money, people can't support these higher equity values, and they must eventually come down. And you start to think about what Dimon knows here, because banks are indeed tightening lending standards and are likely to continue to tighten them, as we've made the case. And that suggests that this isn't what everyone says is a revival and just a pullback in a great big bull market. What it is, it's a beginning phase of what is likely to be much lower equity prices here. And so you start to think about why Dimon might do this. It's real simple. Is it because he wants to go buy T-bills or long-term bonds? Maybe he does. Who knows what he's going to do? But in the future, I'll tell you where that money is going to come back to. When JP Morgan stock crashes, you watch. he's going to buy a whole bunch of it back at the bottom. And that's what a lot of executives do. They'll sell at the top, they'll wait till it crashes, and they'll come back in and rescue the company. As the ECB presses pause after a barrage of hikes to tame inflation, because one thing we know here is the central bankers are getting cold feet. The question is, why is this happening now, and what's going to cause them to switch and start cutting? Let's start with ECB here, because following last month's NIFED decision to lift the deposit rate to a record 4%, policymakers kept it there on Thursdays, matching the prediction of all economists surveyed by Bloomberg. And one of the reasons they're getting nervous is this rapid ascent in rates. And this is historically unusual. Central bankers normally gradually raise rates, and they do that specifically to give the economy and the financial system time to adjust. Well, this time they went crazy because they had no choice. They said, look, we're following the data. Well, unfortunately, the data says we have to keep hiking. And now they're starting to get nervous because they're getting to the point where they realize that they may be the catalyst for the next big downturn in the markets, the next financial crisis, and they don't want to be on record doing it. They don't want to hike and then have the system break apart. They'd much rather hike and then pause, and if it breaks, they could say, look, we didn't do this. We didn't see this other event happening. It wasn't us. Because if a central bank was to take the blame for driving the economy, or the worse, the global economy, into recession, it would be the end of central banks as we know it today. You'd watch governments take them over, and we'd see Congress, if you can imagine, running the Fed. Well, maybe we don't want that either. Having a discussion on cuts is totally premature. Here we see from Christine Lagarde at the ECB reiterating her position from September's meeting. The fact that we are holding doesn't mean to say that we will never hike again. And this is important to understand because central bankers want you to believe they're going to keep hiking. That's what they want to maintain, is we're going to keep going until inflation comes down. One of the challenges is we know that when inflation comes down, it means demand comes down and the economy comes down with it. That's, again, the biggest fear here, is that we're much closer to the end game than they wanted you to believe. As is often with the case with monetary policy, there is this transmission lifetime. The assessment by our staff is that there is still more in the pipeline and more to come to affect the real economy. And the assumption is it will continue to unfold throughout the end of 2023 and the first quarter of 2024. So what she's suggesting is that inflation is somehow magically baked in, and there's this huge lag that they have no idea how long or what it is, because if we knew, we could just measure it with their formulas and say, look, we think inflation should end around this time. One of the challenges here is they don't understand how monetary policy works. They don't understand the financial system. And let's come back to the chart we just looked at, which is, again, the net percentage of banks tightening standards for commercial and industrial loans to firms of all sizes. Because when you start constricting the creation of credit in a debt-based economy, at some point, and this is a variable, we don't know when, but we do know when you constrict credit, the economy slows. Now, one of the challenges is when you're in a giant bubble, we could go back to, say, the global financial crisis, it didn't take a whole lot to prick it. Neither did the dot-com bubble. It all depends on how much money's in the system and how long it takes those tighter financial conditions to affect it. Unfortunately, we can't measure those things, and that's one of the challenges now is due to all the pandemic stimulus. It's taken a lot longer than normal, and that's why we're seeing the reaction in the markets the way we are. But normally, as banks constrict the creation of credit, what happens? The Fed starts lowering rates to incentivize people to, if you guessed borrow, you got it. This is the first time in known history that banks are tightening lending standards, and the Fed is continuing to not only hike, but threaten to hike rates against that. And then you have what's called a double whammy, because you see that the banks aren't creating credit, and interest rates have gone up to the point where businesses and consumers don't want to borrow money. And now all of a sudden, you face a cliff to a global economy. And when it hits, all of a sudden, everything comes crashing down. And even if they drop rates down to zero, it won't be fast enough. And that's why in prior cycles, you've seen this gradual decline by central bankers as banks tighten lending standards. This time, they don't get it, setting us up for an even bigger crash that we don't need. And yet Powell signals the Fed to stay on hold and keep future hikes on the table. And one thing that shouldn't be on hold is the performance of your trading account. Let's give you an update of our gold trade. And this is just how simple this is. Many people say, is your system that simple? It is this simple, my friends. First, you sign up for our CTA Timer Pro. Right now, you get a month free. And just so you know, there are five coupon codes. Once they're gone, who knows when I'll refresh them, but there are 5. You can see it when you go to the website. There are 5 available at the time of recording. And when we see this minus 100 position, and then it starts to short cover, this is what we tell our subscribers. This is your signal number 1 that came on October 12th. Signal number 2, Momentum Timer Pro. Guess what? There are exactly 5 free months coupons left. Once they're gone, they're gone. You got to go grab them while supplies last. Maybe I'll refresh them. We'll see at some point. But then you go over here and you look at this report. It's a tactical indicator report. It looks at a bunch of technical singles, smooths them out. You get a 1 daily buy count. There's your pair single to buy. And sure enough, if you would have bought on that green candlestick at market open, because you get the reports every day before market open and you see the signals, you'd be up 5.8%, certainly much better than you'd see in the market. By the way, links for everything in the description below. Grab the coupon codes while supplies last. Let's continue on, because the comments effectively affirm market expectations for the Fed to skip a rate increase for the second straight meeting when officials gather on October 31st and November 1st. The Fed chief also said a recent run-up in long-term Treasury yields, if they persist, could lessen the need for further hikes. And this is exactly why we saw all of a sudden this massive amount of shorting at the long end of the curve, because market participants who want equity prices to go higher said, fine, you want the long bond to go down? We'll bring it down. And then all of a sudden, central bankers started panicking because they said, wait a minute, this is too much too fast. We don't know how the financial system can absorb it. And if it can't, then, well, guess we're on the hook. Because at the margin, he said, notably, this is going to keep them in check, and underscoring the importance of tightening financial conditions to the rate outlook over the coming months. And we know financial conditions are super tight here. And given the uncertainties and risk and how far we've come, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risk. And so now all of a sudden you look at what Jamie Dimon's doing, right? Selling stock probably near the top, and then you look at this potential doom loop. And where it's going to originate doesn't mean it can't trigger in other places. And that's something in the next big bear market we're going to see all kinds of doom loops and triggering events. And wait till you see this, because this is the one thing. You know, Powell said, we're going to look at the incoming data. Well, we know they change the benchmark all the time. The evolving outlook, yes, that's one thing. The balance of risk, how about this balance of risk? Equity markets start crashing. You want to see the Fed change their mind? Oh, you bet they will. And yields on 2-year treasuries declined after Powell spoke, while 10-year yields paired an increase and pushed them near the 5% mark. The dollar fell against a basket of major currencies. And why does a 2-year yield matter? Because it is actually a better predictor of the federal funds rate than the actual policymakers are. Here we can see this chart here. We've got the federal funds rate in red against 2-year treasury yields in blue. And here's what we can see is yields tend to lead where the funds rate goes. And then even then the yields come crashing down, the funds rate starts to fall. And we see that almost every cycle. You notice here the Fed goes into pause mode and yields are saying, boss, see you later, Fed. You can play catch up. And sure enough, what's happening now is 2-year yields are not staying ahead of the funds rate. If you want to know why we're seeing the Fed go on ice here, it's because if Powell's watching the bond market's telling him, hey, look, you better knock this off. You're going the wrong direction here. So he's got to come up with an excuse, because he doesn't want to be on the wrong side of this. If 2-year yields start come crashing down, and at some point they will, you watch, they're going to have to be pause, and then you watch the Fed start to cut rates in a big way, because that's where we're going to start to see things unwind. And yet, what do we see today? Inflation numbers from the PCE looking pretty strong. We'll still see a pause from the Fed. But why are we likely to see inflation come down? Well, there's a big reason. As U.S. core PCE prices jump most in 4 months, the spending picks up. And wait a minute, this is pretty interesting. We talk about spending coming to a halt here because what are the catalysts? Well, we know we have the student loan repayments. That's a factor. We know that the pandemic stimulus supposedly was running out. That's a factor. But we also know that banks have been extending credit on the credit card limits. So that's an unseen factor. So we know that consumers are tapping credit, but there's something else they're doing that's a bit unexpected here. The core personal consumption expenditures price index was stripped out the volatile food and energy components, rose 0.3% in September. Inflation-adjusted consumer spending jumped 0.4%. So what does that tell us? Is that consumer spending is up and it's not really driving inflation. So that's a good indicator. It's not driving as much as it could. Resilient household demand paired, of which I'm going to argue this resilient household demand part, paired with a pickup in inflation underscores momentum heading into the fourth quarter. So that means fourth quarter should be strong, while economists generally expect consumer spending to slow in the coming months, which it will at some point. Fed officials have warned that strong data could lead them to keep tightening, telling consumers, hey, stop spending or we're going to raise rates. But the consumer is nowhere near as resilient as you think because they're doing what we call binge borrowing at the wrong time. Remember, at every peak of every cycle, what happens? There's record debt. It's always an issue. High debt, high interest rates, always the same problem, always the same answer, just cut rates. And while wages and salary rose to 0.4%, real or inflation-adjusted disposable income fell for a third straight month. So there's a factor there. Inflation-adjusted disposable income is down. As a result, consumers have been saving less to support their spending. And so now we get a really key point. The savings rate fell to 3.4%, the lowest this year. That may raise concerns about Americans' abilities to keep spending at such a pace through year end. So what we're seeing now is Americans are unable to save the amount they want to. And if for some reason they're spending their savings down, as if they're kind of buying into this soft landing narrative that the Fed has kind of presented to them. But what this tells us, it tells us one very key thing is that at some point that his savings rate is going to drop enough and consumers are going to get uncomfortable by that amount of money they have in the bank. And when they stop draining their savings and start building them back up, well, that's the end to this inflation surge altogether. And here you can see the consumer price index shown in blue on a year-over-year rate of change against the personal savings rate. We can note that going into recessions where consumer prices come down, savings rate rises, so people save money to spend less. And that's exactly the trend we expect to see here. You see in the global financial crisis. And now look, you see why is inflation rearing its ugly head here? Consumers are drawing down their savings. We know their savings rates are at one of the lowest levels in history. And when they change their mind and they see the economy slow and job losses pick up, you're going to watch the savings rate go up and you're going to watch inflation come crashing down faster than the Fed is prepared to deal with it. And something else, we talk about this crash, this doom loop now. We go back to Jamie Dimon, selling potential to the peak, assessing risk. He knows that banks are not going to keep extending credit to consumers. They're going to hit a wall. The spending is going to dry out. Stock market's going to come down, and it's going to cause some triggering of doom loops. Now, let's get to where this is going to happen. I want to set the stage here because there's a little bit of interesting information. As China industrial profits rise again, as growth stabilizes, the continued improvement in industrial profits suggested demand is likely recovering, even though we made the case that this is transitory, as the government ramped up measures to aid growth, while companies probably approach the year-end of destocking cycle, or at least they're hoping. Declines in factory gate prices, well, there you go, indicated by the producer price index, narrowed to 2.5% in September, suggesting we're still in a deflationary environment, at least in China, while manufacturing activities recorded the first expansion in 6 months. But that's not the issue. This is where I want to get to. The profit improvement is in line with this recent rise in PPI and PMIs, signaling the industry is bottoming out, or at least what you see. This is the hope. The hope is that it's bottoming out because Chinese shares, stocks, went up on Friday. And this is key because now look at this. China's sell-off threatens $27 billion of snowball derivatives as these structured products are tied to Chinese indices are at a risk of loss. And here's a catalyst for it. Another 10% decline in major Chinese equity gains may trigger a wave of selling in index futures tied to structured products adding a fresh risk to the slumping stock market. Investors face losses in complex snowball derivatives at maturity when a benchmark falls below so-called knock-in level, and that is the issue. You start hitting these knock-in levels, these things start triggering. Of course, then we know the machines, which have kind of started to lever back up, they start selling, volatility starts to spike, and then vol control products start to sell, risk parity products start to sell, and next thing you know, you have this spread of selling that just rolls through the global economy, and that's why the Chinese stock market is so critical, and any news to drive it up is important because Chinese stocks have had a rocky start to the year when multiple rounds of policy stimulus failing to put a floor into the market slide. Maybe this is a real reason Beijing is really interested in getting some stimulus out there, as persistent property woes, geopolitical tensions, and imputed economic outlook have all sapped sentiment towards the nation's assets. And of course, we know, and maybe Jamie Dimon knows. If you don't think he knows, about all these derivatives and all these things, because his bank sells this stuff, so they know, he knows, and that's why I made the case early in the show. He knows we're near the top of the market. He wants to start selling, get his money out, and you watch when JP Morgan stock crashes. Who's going to run to the rescue? Well, none other than Jamie Dimon, because once we see these knock-in levels trigger, it's going to spread around the world, and it will cause chaos as stocks around the globe crash. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.